It's a pretty surprising phenomenon, actually, against the backdrop of an ongoing trade spat, tit-for-tat embassy closures, and a blame game over the virus. Chinese companies are turning to list in the U.S. in droves. 21 such companies have gone public in the U.S. this year. That's nearly double the number we saw over the same period last year and represents 15% of the total IPOs in the U.S., the highest proportion in a decade. That's according to data by DealLogic. Chinese companies have raised $4 billion, a jump of 60% from the same period last year. The latest of these is Li Auto, an electric SUV maker, which generated $1 billion from an IPO yesterday. That stock surged 43% in its debut. In some ways, these numbers defy logic. In addition to the cross-border geopolitical tensions, the recent IPO of Luckin Coffee at the Nasdaq became embroiled in an accounting scandal that sent shares plummeting. That historically has been enough to turn off American investors to Chinese listings and scare Chinese companies from listing in the U.S. But sources say investors in Chinese companies seem to be ignoring the headwinds. Why? Well, the U.S. market is seen as the ideal destination for growth companies because investors are willing to fork up capital to pay for them right now, and these Chinese growth companies need that capital. Now, to be sure, some of the larger potential Chinese listings in the pipeline are likely to take place closer to their home bases. Sources say there's ongoing dialogue around Ant Financial and ByteDance, the parent company of TikTok, to pursue IPOs in Asia, but no final plans have been made yet.